All right, good morning, everybody. Please let us know in chat if you can hear us. Thank you, Steve. This is just a reminder that this event is being recorded. Elderworks Educational Services is a not-for-profit 501c3 organization whose mission is to provide older adults, seniors, and families information, referrals, and guidance for senior living, home care, and supportive services to help make appropriate decisions. This includes education on senior topics for community members and professionals. The guidance we provide will help seniors stay home well or transition successfully into a new senior housing opportunity. Today, we will be introducing Esther as she talks about helping you plan for long-term care.
Hi, everybody. My name is Esther Viti, and I am with the Viti companies. We are a full-service insurance agency, third generation, started by my grandfather 85 years ago. We're here because your life and your health don't just affect you. They affect all the people who love and care for you. So it's best to discuss potential long-term care costs before they happen and make a plan together for your loved ones. As I mentioned, we represent all the most of the major insurance companies. So this is just a disclaimer. I am here just to give you an overview of the planning process and talk about just an overview of some of the products that and planning options that are available to you. Everybody is different, and so just keep that in mind. I have several goals for today. And when we're finished, I hope you will have an appreciation for the need to plan for long-term care well before you need it, similar to retirement planning. You'll have an increased awareness of how long-term care event impacts your loved ones, and therefore the importance of including them in the planning process. And finally, I want to make sure you learn about some of the options that help mitigate the risks of long-term care and instill a sense of confidence about your future. So what is long-term care? Long-term care, it's a variety of supports and services designed to help people live as independently and safely as possible when they can no longer do so on their own. So a long-term event occurs when you cannot do 2 out of the 6 activities of daily living. The best way to think about the activities of daily living are: you wake up in the morning and you get out of bed, that's transferring. You walk to the bathroom and you can hold it, that's continence. You go to the bathroom, toileting, you brush your teeth, bathing, you get dressed, dressing, and you eat breakfast, eating. So it's transferring, continence, toileting, bathing, dressing, and eating. If you need assistance doing 2 of those, you have a long-term care event. So what are your thoughts on long-term care? Okay, what do the words long-term care mean to you? Does anybody have any thoughts? You can put your thoughts in the chat.
Long-term care, that's going into nursing community, is it?
Potentially. For a lot of people, the words long-term care brings nursing home to mind. A nursing home is a place. Long-term care is an event that deserves some type of planning. So keep that in mind. The good news is, the good news is 52% of care is done at home. 20% are in an assisted living facility, and only 28% of care is done in a nursing home. And 38% of that are recoverable strokes, orthopedic surgery. Somebody has hip replacement surgery, they usually go into a nursing home to recover. Most of those events are recoverable. So the majority of care is either in home or assisted living. Therefore, it's important to plan so you have flexibility. A recent study of 1,000 Americans and 500 financial professionals conducted by Lincoln Financial highlights the issues that individuals and financial professionals face when planning for long-term care. I'll be referring to these throughout the slides. So the number one first misconception is it won't happen to me. Believe it or not, people think that it's going to happen to their spouse. It may happen to their parents but it's not going to happen to them. And the reality is the actual risk is much higher for everyone. Number 2 is Medicaid or Medicare or my health insurance have me covered. If that's what you think, then you're in great company, because 65% of Americans believe that their Medicare, Medicaid, or health insurance will cover their long-term care event. And I will refer back to the slide a little bit later. Number 3 is that's what my savings are for. Self-insuring is right for some people, but you want to make sure that you know what the cost is. So surveyed people, the average person thought it would cost $54,000 annually for a private home and a nursing home. In actuality, right now, the annual cost of a private room in a nursing facility is $113,000. So how far would your savings go if you had a long-term care event that lasted 3 to 5 years? Another misconception about risk of long-term care is my family will take care of me. Now think about your family now. Think about your kids, what their responsibilities are. If you have a long-term care event and one of the spouse works, how would that impact them? You know, the caregiver, a spouse is normally a caregiver in a lot of situations, but there is a lot of impact on or negative impact on their health. The blue bars are a percentage of families surveyed, and then the green are a percentage of families in the situation now. So as you can see, you know, it's costs the caregiver emotional challenges to their physical health, time, lost wages, because if the spouse is working, they can no longer work, and also your lifestyle changes. If the cost of care is so high, then how is that going to impact your lifestyle? All things to think about if your family is your plan. Now, paying for long-term care is another misconception. I talked about this in an earlier slide. Health insurance. Health insurance does not cover long-term care. Okay, Medicare. Medicare will cover a portion of skilled care costs for up to 100 days. So if you go into a facility and you have a stroke, think of it this way. You go into the hospital, you have a stroke. Then you go to an assisted living facility or a nursing home for rehab. Your Medicare will pay for that. Now, after you've been at rehab and you're not going to get any better, but you're not going to get any worse, they say they can't do any more for you. Now it's time to go home. You can go home, and Medicare will pay, in most cases, up to 47 days of care. In some cases, 100 days of care. But after that, you're on your own. Medicaid covers people with less than $2,000 in assets. So you have to spend down all your assets for Medicaid to kick in. In that situation, if a legacy is part of your retirement plan, that might not be a great option. I often am asked if long-term disability covers long-term care. Long-term disability is really ensuring your paycheck during your income earning years. When you leave work, the disability insurance goes away. So that also is not an option to cover your long-term care costs. So the cost of care. Now this survey was done released in April of 2022. So in 2022, the cost of home health was about $61,936 a year, or $27 an hour. You might not need care around the clock, but it's $27 an hour. So that tends to add up. Assisted living facilities, 1-bedroom, single occupancy is about $57,000 a year. And a nursing home private is about $99,000, and a nursing home private room is about $113,000. So it's less expensive if you have a semi-private room, and obviously the nursing home is the most costly. So how are you going to cover the plan for care? Okay, so long-term care is generally paid for, well-being, lifestyle, dollar for dollar expenditures, which would be paying out of your income and your assets, or the most cost-efficient way is covering it with some type of insurance product. All right, this is not coming on the slide. Okay, now, have you started planning for long-term care? Has anyone in the audience started or giving it some thought? In most cases, they haven't, but a lot of times when people have a parent experiencing the cost of care or a friend's parent, that's when they start thinking about care for themselves. So here are some things to think about. While you're receiving care, is your spouse going to have financial security? Are you supporting anybody else? Will you have to sell your house? How are you going to pay for the cost of care? We just reviewed what the cost is. When it comes to care, having options, I'm guessing, is preferable for most people. If your family is available to care for you, and there are some people that are willing and able, or would you prefer to have care at home and not have to go into an assisted living facility or a nursing home? And then again, care from family and friends should really be a choice. I mean, the last thing you want to tell is your child who might be dealing with teenage kids or even college costs. Now they're going to have to pretty much stop everything and help you decide of a plan of care, or maybe take their time, maybe move you into their home, or have to take time away from their job to help you. Planning starts with a conversation. Okay, so have you talked with your spouse? The spouse is going to probably be 52% of spouses are the caregivers. Parents, 35%. I mean, that's probably not going to happen in most cases because long-term care usually starts at about age 82. Your children, 29% of kids are taking care of their parents. But like if I use myself as an example, I have kids that are teenagers and my parents now are in their 80s. And I have a sister who has older children, so she can do most of the heavy lifting, but it would be very difficult for me to give all my time to my parents. I'd want to do that for them, but it might be nearly impossible. And then friends. I mean, who would like to ask a friend to have to take care of you? I'm sure they do it, but again, you're impacting their lifestyle as well. It's just a conversation to start talking about it, because if you are of that planning age and you do have adult children, my guess is they probably are thinking about it. Okay, now self-funding long-term care. Self-funding, as I mentioned before, is an option for some. Like, do you have enough personal and financial resources? If you do, then you can fund long-term care. It's nice to put that in a vehicle where you can leverage it and you will get the most bang for your buck. There are policies for that. If you set aside an asset to grow and cover long-term care, will it grow enough by the time you need it? For example, if you're putting together, like, let's say real estate or an asset that you're going to have to sell, will that be in a position to sell when you need the long-term care? Because long-term care pretty much kicks in right away. If you do dip into those assets, how long will those assets last? That's why the long-term care planning, especially if you're self-funding, should be part of your retirement plan. The last thing you want to do is have principal in the bank where you're living off the income, and all of a sudden one of the spouses gets sick and now your expenses increase exponentially. How long is that your principal going to last? So why include long-term care coverage in your plan? Long-term care coverage, some people talk about it as protecting your retirement plan, like insuring your retirement plan. So if you do have a long-term care event, your plan doesn't get blown up. If your legacy is part of your retirement planning, then leveraging long-term care planning will help preserve your assets. Keeping options open, like being flexible, having to make that decision to sell your house, if you want to sell your house and go into an assisted living facility, or if you want to stay in your house, having the flexibility to be able to do that. And then keeping your caregivers in mind, like, how are you affecting them both emotionally and financially, especially if your spouse is young? I mean, we're all living longer. So that's why it's important to make sure that you have some sort of coverage if you need care. So we talked about self-funding. Let's talk about insuring your plan. There are different options or different ways to insure your plan. One of them is a traditional long-term care standalone policy. This type of planning gives you the most coverage for your money. The negatives to this are premiums are not guaranteed, and generally they're only lifetime payment schedules, which means you pay into it until you need it. And then if you pass away and not need it, it goes away. So there's no money left over for the beneficiary. That does work for some people, but it's not ideal. There's also now life insurance with a long-term care rider. So if you need life insurance or you have a life insurance policy and you need it for replacement of income now, but as you get older, you can pull the death benefit forward to cover long-term care. And if you don't use all the coverage, there is money left over for the beneficiary. In some cases, the premiums are also flexible, but you can also pay them up either in a lump sum, 5-year, 10 pay. So the premiums are a little bit more flexible. You're not limited to just a lifetime income. And then there's what they call like a linked benefit long-term care policy. This policy is the primary need is for long-term care, but if you don't use it for long-term care, the premium will be recoverable for your beneficiaries. You can also pay this in a short period of time. So some people might move a portion of their retirement assets into this type of policy and leave it there. And if they need it for long-term care, it gives them about 3 times the amount that they would have if they were just paying out of their income. And then it is flexible premiums. And again, there is money left over for your beneficiaries. Now, understanding how the benefits are paid, it's different. The long-term care standalone policies are mostly reimbursement policies, which means when you go into care, you will provide the bills to the insurance company and then they will reimburse you, okay, for the qualified expenses. So here's an example here. This is a hypothetical example of somebody who has a policy that will pay up to $7,000 a month when you need care. Okay, so on the reimbursement side, the insured will provide the cost to, or the receipts to the insurance company, and they will be reimbursed for what they paid, which is $3,200 a month. Okay, so although they have $7,000, they're going to get reimbursed $3,200. If you have an indemnity or a cash indemnity policy and you have a long-term care event, there is no monthly proof of bills. You do not have to submit receipts, and you will get the full $7,000 a month, regardless of how much your cost of care is. So you can use that $7,000 or the remaining $3,800 with no restrictions. And the cash indemnity is absolutely like no restrictions, which means you don't have to, you can have your family member take care of you and pay them. They're just going to send you the $7,000 after the insurance company has improved your care. Does anybody have any questions so far?
There's nothing in the chat. All good.
What is the remaining 3,800?
Okay, so with the hypothetical example, this long-term care plan will pay up to $7,000 a month. So the person with the reimbursement, or I should say, this example is saying that the cost of care is $3,200 a month. So although this person has $7,000, they're only spending $3,200 a month. So therefore, there's $3,800 left over. Now that would go into the next month. So I answered your question? Okay. You know, how do you qualify for a long-term care claim? Okay, the way it works is if you have a cognitive impairment, and that would be Alzheimer's or dementia, then that isn't considered a long-term care event. Or if you can't do 2 of the activities of daily living. We discussed the daily living, the activities of daily living. So if you need assistance doing 2 of those, that is considered a long-term care event. And then you reach out to the insurance company, and the insurance company provides a plan of care. Once you receive the plan of care, and there usually is an elimination period. On a previous slide, we talked about the fact that Medicare will pay for usually the first 47 days or the first 100 days of care. So most of these policies have about a 100-day or 90-day elimination period, which in that case, you would self-fund until the benefit kicked in. Once you have the long-term care event, the reimbursements will start, or the stream of income. Does anybody have any questions regarding when a claim begins? Okay, so what to look for in a solution? Okay, first of all, where do you want to have care? Like which state? Different states cost more. Some people want to have states, believe it or not, out of the country, where your plan pay for you if you are actually out of the country. And there are plans that will. Will the coverage cover temporary claims? Most of the policies will cover temporary claims as long as you meet that elimination period. They will pay you until you don't need it anymore. And then everything will reset, or what you have used the policy will be removed, and you'll can use the remaining dollars in the policy when you have another long-term care event. There are policies that can increase in the future, and that really is mostly the long-term care standalone policies. There are very few standalone policies available at this point. Mutual of Omaha is the one that is sold most. And although they have raised their premiums on their older policies, they've been selling policies since the 1980s. The most they've gone up is about 20% on those older policies, but they haven't increased a premium for policies bought after 2007. So the goal is not to raise premiums, but they do reserve the right to raise premiums if you have a standalone policy. Life insurance policies and the hybrid policies guarantee that the premiums will not increase as long as you pay them. And then how are benefits paid? I mean, do you like the idea of having to submit receipts? I'm doing that actually for my parents right now with John Hancock, and it's pretty seamless. You just can do everything online. Other companies might not be as seamless. Or would you prefer to just have the money sent to you once a long-term care event occurs and not have to deal with receipts, just get that money as long as you need care? So those are important things to think about when you're deciding what type of policy to purchase. Okay, so how much coverage will you need? I mean, no one knows for sure, but if you'd like to estimate it, there are assessments, your current health condition of the client. If somebody has MS, like you could have MS and not need long-term care, but if you do have MS, there is a chance you will need long-term care longer than you may with somebody that doesn't have any health conditions. So you want to take that into consideration. What's your lifestyle and health history? Do you smoke? That's going to impact the cost of the care. So those are important things to just know up front before you make that decision. So here's an example as a result of the long-term care assessment. So these two clients right now are 55 years old. And after completing the assessment, it's been determined that Jim will most likely need services when he is 77 years old. So he's looking at the monthly cost of care now for home health care, assisted living, and nursing home care, the monthly and the annual cost. He's inflating that by 2% for home health care, 3% for assisted living, and 3.5% for nursing home. And then he comes up with his annual cost per claim at the time of care when he's 77. Now he's in Ohio, so the cost in Illinois might be different. But so his planning and the amount of care he's going to purchase will be determined by his cost of care when he needs it. Jane must not have any health conditions. She needs it about 10 years after Jim. So she determined her care is going to cost obviously a little bit more using the same inflation options as Jim did. Now, I like to say to people, you don't have to 100% fund your long-term care. You're going to have other assets that you know about. You're going to have Social Security. You might have a pension, but ensuring even a portion of it will help offset those large costs. Okay, so I have a copy of this for everyone who's here today. And also we'll send it out to the people who have watched online. Thank you for coming. I'm not going to go through all these slides, but I'd like to go through just some of them, and the differences. For example, we talked about traditional long-term care policies. They provide the most care for the least amount of cost. You can purchase as much or as little of long-term care as you'd like. So it's the most affordable. There is not a 10-pay option available, so I apologize. That should be removed from the slide. In these policies, they're not guaranteeing the premiums, and If you don't use it for long-term care, there's nothing left to your beneficiary. That might not be an issue for some people, but it may. So it's really you lose it or lose it. You use it or lose it. There's no return of premium. Then there's a life hybrid with long-term care extensions. Now, these are life insurance policies, and there are many types of life insurance policies that you can add the long-term care rider to. These premiums will not increase. All the premiums, even for the long-term care, in most cases are tax-free. Okay, there's a flexible premium option with the long-term care, with the life insurance policies, and there might be tax advantages through your HSA or paying through your HSA or HRA. That's something you talk about your tax preparer with. There's also limited funding, and the best advantage, or the biggest advantage, I think, that people appreciate: if you don't use it, then your beneficiaries get either unused or all of the death benefit. And then there are like the life hybrid with long-term care. This gives you the opportunity to put away a lump sum, so you can transfer some of your assets to these types of policies and just leave it there. If you need it for care, it's there for you. And if you don't use it, then your beneficiaries will get any unused premium. And there are also annuities with long-term care riders. So there are several different options to choose from. Some of them are better if you purchase when you're in your 30s, 40s, early 50s. Some might work better when you're older. Some are better for those with impaired health. There are options that are available. So I will send these to you. Now, some of the questions to consider, like, where and when do you plan to retire? We talked about the cost of care is different by state. And also some people might want to have care out of the country, which those indemnity policies would be better if you're not going to be in the US. What type of, what would a chronic condition have on your income? Some people do have chronic conditions when they're older and they're still working. Like, who's going to take care of you? How is that going to impact your income? Do you have the savings for it? And what type of care do you prefer? Would you prefer to have a caregiver? Would you prefer to have your care at home? Or would you like to move into an assisted living facility? My guess is your last choice would be a nursing home, but in some cases you might not have that choice. So that's something to consider. And what solution can you comfortably afford? Again, there are several different types of solutions. The great thing about long-term care is you can purchase as much or as little as you'd like. And so there are options that are available to you. Now, this example, I think, is pretty impactful. I just want to see if you can see it on the slide. Okay, so this is a traditional long-term care policy against self-funding. Okay, so these people this is a 55-year-old couple. Okay, now the couple on the left, on your left, they are putting $544 into a long-term care policy with a joint long-term care policy. So their cost is about $544 per month. Again, we mentioned they're 55 years old and they're purchasing about $6,000 a month for 3 years. Okay, so the next couple is self-funding. So they're putting $544 a month into an interest-bearing account that's getting about a 5% annual return. So at age 85, you can see the benefit of the long-term care policy, where with the inflation option, so the traditional long-term care policy has a 4% inflation option, their care bucket, or the money available for them for care, is about 2.7 million. And that is because they purchased a policy with a 4% inflation rider. And the self-funding option, which is in that 5% interest-bearing account, gets about 403,000. Now, if you're in an interest-bearing account, you are paying taxes on it, so throughout the year. So that's why you have to take that into account as well. So if you are interested in exploring or seeing the options available to you when you use a product to help with your planning, you will have more money in most cases than if you're self-funding it. So if you're self-funding, just make sure that you're funding it enough to have the care for you. So what are the next steps? The next steps are get a personal long-term care assessment. I am available to talk to you if you'd like some care, or your financial professional, and ask them to complete an assessment just to see what the cost of care would be for you. Look at, if it's part of your retirement plan. Again, I mentioned if you're working on your retirement plan, you want to make sure that you are accounting for a long-term care event. If legacy is part of your retirement plan, make sure that that's covered so you don't have to spend down all your assets. And just consider the long-term care options that will work best for you. Planning ahead definitely protects your care, your choices. It protects your spouse financially. It, protects your children, not just your legacy, but just the stress of making sure that you have the best care possible, and to make sure that you can make a decision for your care and have the flexibility of deciding where and when you want it. So with that, I'd love to open it up to questions. I really appreciate your time. Thank you for the opportunity. And I would love questions if you have any. Thank you, Curtis.
I have a question.
Yes.
So when would you say is an appropriate time to start speaking about long-term care planning with your parents?
I think an appropriate time is usually when they're in, there's never a negative time, but 60s, 70s. The long-term care and insurance is most affordable when you're young and you're healthy. So that's why a lot of the life insurance with long-term care is optimal for people that need life insurance to protect their income when they're working years, to protect their family. They can add the long-term care rider on it, and then they'll have care when they're older. With parents, though, I would start the conversation now. I mean, there's never a time. You don't want to wait. Don't want to wait till they're in their 80s, where it's going to be difficult to find a planning option.
Okay.
Great question. I appreciate it.
I had a question.
Yes.
If your parents were looking to get long-term care, is there like a discount or combined plan for both of them, or do you have to insure them separately?
The policies are separate, but there are shared care riders with standalone long-term care policies. And I actually present that a lot to my clients, because it's 1 and 2 are going to use the long-term care. And if you have the shared care rider, the other spouse can use the spouse that hasn't used it yet benefit if they go through there. So that's a great option. There also is a discount on some of the hybrid policies. If you're married, you get a couples discount, even if they don't apply. But yeah, there is a discount if you're married with some of the products. You're welcome.
Hi.
Okay, well, thank you, everybody.
Esther, yeah, real quick, it's Barbara Rosenberg from ElderWorks, Senior Advisor, and nice to see you. Very nice to see you, having grown up with your entire family. Thank you so much for coming on. I want to, I watched the whole presentation, it's amazing. I just want to say a few things real quick. As a senior advisor in long-term care insurance, one of the things that we do is we educate the adult children who are looking for parents that want to move to senior living, be it assisted living, memory care, skilled nursing. We assist those people in how their long-term care insurance policy would kick in to move to a community, and also to the adult children that should buy these policies and prepare for their future. So I just need to say that it's a big educational process for all of us. So I just wanted to mention that, because that's really important in terms of all this valuable information. I think it's the most important insurance there is, and they've luckily come out with some hybrids. It's great. The days of the long-term policies that are lifetime policies that people paid in years ago are no longer, as obviously, as you know, and a lot of dementia in the population, and that sort of caused a lot of companies to go out. So anyway, this was wonderful. And we have an evaluation that's going to pop up on your screen at the end of this presentation. And Emily and Mo, thank you, Lisa, also from our office, for everything you do and for helping us. And so I just wanted to say hi to everybody and thank you to everybody, and be sure to fill out that evaluation. It really helps us. Does anyone else have any other questions?
Okay, before I sign off, I also want to thank ElderWorks for giving me the opportunity to speak to you. The team has been great, very professional. It's been a great experience, and I look forward to hearing more about the services that you guys offer here, because you have a great team. So thank you so much. And my information is on the last slide. If you have any questions, please feel free to reach out.
Thank you. And also for your evaluations, events@elderworks.org. And we're ELDERWERKS. If you have any questions, or our office phone number is 847-462-0885. And thank you for coming on, and to all the public that comes on to our events. We so much appreciate it. So